Welcome to the Insurance and Money Podcast. We're here to educate on the topics of insurance and money. I'm your host, Karla Howard. I want to thank you for tuning into the show today. Today we will discuss whole life insurance, where everyone needs life insurance and the different types of insurance. On this show, you can expect to learn about the different types of insurance and how they relate and apply to you. Also, we will discuss your money as well, such as checking and saving accounts, credit cards, and mortgages. On our last episode, we discussed Index Universal Life. I hope you gained a greater detail and understanding of IUL. I know it can seem complex, but we will continue to break it down and talk about it to make sure it's very easy to understand for you. The goal is complete understanding so that when you buy insurance, you buy the correct policy that protects you and your family. Now, I was told by someone that whole life insurance and IUL were the same, but that's not correct. I will go over whole life and do a comparison of these two permanent policies today. Whole life insurance is the most popular permanent insurance. It's designed to maintain coverage till age 100 or 120, depending on the policy. It can also be the most expensive of the life insurance policies, but with a licensed insurance agent, it can be structured to meet your needs. Now, it's not as flexible as the IUL policies, and there are different types of policies, such as 10 pay and 20 pay whole life, participating whole life, non-participating whole life, single pay life, variable life insurance, and guaranteed issue life insurance, and many others. Now, 10 pay and 20 pay whole life. These are permanent policies that are limited pay, and you only make premiums for a specified period, such as 10 years or 20 years. And they're considered paid up, meaning after that specified period, you don't have to make any more premiums and you have lifelong coverage. So their payments are a short specified period. The cash value will accrue much faster, and this means loans and withdrawals will be available sooner than most whole life policies. Now, participating whole life insurance. This is sold by an insurance company that allows for profit sharing of the insurance company through dividends. These dividends are not always guaranteed, but when available, they can be used to purchase additional insurance and used to lower premiums, and they can increase the cash value portion of the policy. Profit sharing is based on the insurance company's performance and investment gains and mortality savings. Cash value grows much faster and can be accessed through loans and withdrawals. Dividends are not always considered taxable income. Now, for non-participating whole life insurance, I consider this more of a traditional insurance policy. It offers lifelong coverage with guaranteed death benefit and cash value growth. It doesn't offer dividends through profit sharing, and it's more affordable than the other participating policy. You have fixed premiums, lower premiums, guaranteed death benefit, and cash value accumulation. Now, single pay whole life is a permanent whole life policy where you pay for the lifetime coverage upfront. The policy has no additional premiums. Now, this is not for everybody because it's a significant payment up front. You do have immediate coverage. You can borrow against it. Cash value will accrue much sooner than normal. But with the upfront payment, buying it for an extended number of years upfront can be extremely costly. So, again, it's not for everybody. Variable life insurance. This is a permanent policy that allows policyholders to invest their cash value into stocks, bonds, and mutual funds. There is cash value that's guaranteed, However, it can fluctuate due to the performance of investments. Keep in mind that this policy does have a huge investment risk, unlike the other permanent policies. So it is permanent. It does build cash value. There is premium flexibility, and the earnings are not taxed until they're withdrawn or borrowed. Now, guaranteed issue whole life insurance. This is one of the more popular ones. This is a permanent policy that guarantees coverage regardless of the applicant's health or history. There are no questionnaires, there are no medical exams, and some companies will only pay out premiums if death occurs within 2 years. After the 2 year period, the entire face amount will pay out at the time of death. These are policies that usually range between the ages. You buy it when you're like between the ages of 45 and 80. You don't have that medical exam. However, there are lower death benefits with the guaranteed issue life insurance. The death benefit is usually under $20,000, and the premiums are typically higher due to the higher age at purchase and the fact that there are no medical exams, questionnaires, and they're not asking you about medical history. But you do have cash value that is accumulated. The primary difference between IUL and whole life is how cash value grows. Whole life guarantees a fixed rate of return on the cash value, but IUL links its cash value growth to a stock market index, producing higher returns but bringing the potential for risk. Keep in mind, as stated in a previous episode, the risk doesn't mean your cash value will be lowered or lost because of a market index is used as a benchmark to determine how much interest is credited to the policy's cash value. You won't see the cash value decrease, but if there are market losses, it won't grow. I believe this is why many agents push the IUL for retirement income, because the stock market doesn't work the same as the IUL. The stock market refers to a broader system of exchanges where stocks are bought and sold. This brings the potential for loss in a market decline. Now, once again, I'm not recommending using IUL as your investment source, as we talked about in the last episode. This is an insurance product, not an investment product. I would say that there are agents, and I've seen some agents sell it, and they tell you to take your IRA, take your 401k, take your 403b, stocks, bonds, mutual funds, etc., and put all of that money into an IUL. And I don't recommend that. I would like to tell you to please see your financial advisor and diversify. Now, you can use life insurance to better your financial situation. However, that's not the same as putting everything into an IUL. In our next episode, we will give examples of term insurance, IUL, and whole life. There are other topics we will explore as well. Thank you for tuning into the show today. Please tune in every Wednesday at 7 p.m. and we'll continue our discussion on insurance and money issues. I have examples and tips to share. This is Karla signing out. Until next week.